Are you trying to pick a global stock fund for your ISA or SIPP? In this video, I look at the best funds for UK investors and break down how they work so you can see what really matters. Should you go for one that tracks all markets or just developed ones? What about tax, fees, and platforms? Let's find out. And remember, if you do enjoy our content, please do subscribe to our channel and like this video. So what are you buying with a global stock fund? Well, if you buy a passive fund, then there are two things to think about. The first one is which index your fund is tracking. Now, there are index providers which provide multiple global indices. So that would be companies like MSCI, FTSE Russell, S&P Dow Jones, and even Bloomberg. So they produce these lists of stocks around the world, and then they provide that to asset managers for a fee. The asset manager then goes out and buys the stocks inside the index, and it keeps it up to date. So what really drives the value of the fund is the list of stocks in the fund. So the primary driver is the index itself. It's not so much about the fund manager. So let's take a global index fund, and this is one from MSCI. It's the All Country World Index. It is a truly global index. It doesn't buy all of the stocks in the world, but it does buy a very large proportion of them. So this MSCI ACWI index is tracked by multiple asset managers. And what I've shown here is a handful of those trackers of MSCI ACWI. Now, these funds have a correlation to MSCI ACWI of more than 99%. Essentially, you can see that they're all moving up and down pretty much in lockstep with each other. And over this 10-year period, you can see that their returns are very similar indeed. The difference in annualized return between the best and worst performing is only 1/10 of a percentage point. Now, those differences can add up over time, but you can see that the primary thing here is the index that we're tracking. People often get really hung up on which global index fund to choose, but you can see that they are very similar because they track the same thing. So that means that your primary choice will be driven by things like cost. If you've got 5 funds which are tracking the same index, you'd usually choose the one which has the lowest fee. But as we'll see, there are other considerations. Now, it's often surprising to people who are new to investing that if you do look at a global index fund and colour in bits of a global map according to the weights of the index held in each country, it doesn't look very global at all. Firstly, the US is completely dominant. It makes up 64% of the global index right now, for MSCI at least. And other countries are much less dominant. For example, Japan is 5%, the UK and Canada 3%, France and Germany 2%, and the whole of Australia just 2%. And most of the map, you'll notice, is not coloured in at all, despite this being a global index. So really what we're talking about when we say global is weighted by the size of the finance industry and the equity market capitalisation in each country. And to first order, global is US. Given the fact that many global funds are almost interchangeable, fees and the platform that you use to buy those funds are very important. So your investment platform is where you buy and sell and hold the individual investments in your portfolio. And it turns out that the platform itself can determine which funds you can buy. Now, some of those constraints are obvious. For example, if you're on a platform like Trading 212 or Invest Engine, these are ETF-only platforms. You can only buy exchange-traded funds. On other platforms, you can buy an alternative legal wrapper, which is called an open-ended investment company. Now, that legal wrapper does not affect the returns of the fund or its risk. Remember, that's driven by the index which we're tracking. However, it does affect the venue on which the fund is traded. So an exchange-traded fund, as you can probably guess, trades on a stock exchange like the London Stock Exchange. Whereas if you trade a fund, your broker will be trading directly with the fund manager. ETFs are priced daily, minute by minute usually, whereas OEICs only have an end-of-day price. But the holding fee, in order to hold your investment on a given platform, also varies according to what type of legal wrapper you've got for the fund. On some platforms like Hargreaves Lansdown and AJ Bell, then it can become very expensive to hold funds rather than ETFs. And that's because ETFs have a cap, a monetary cap, on how much it costs to hold those funds. So for example, if you have a Hargreaves Stocks and Shares ISA, then if you hold funds, that's OEICs, and you hold up to £250,000 worth of those funds, the fee on that is a percentage, which is 0.45%. In contrast, if you hold ETFs on Hargreaves, the fee for holding those is capped at £45 a year. That means that if you do the sums, if you have more than £10,000 worth of a fund, then it's going to be cheaper to use an ETF rather than an OEIC. On other platforms, there's no distinction in holding fee between OEICs and ETFs. So for example, on Vanguard, the holding fee is the same for both. So your choice of fund will be affected by the platform you choose. So it makes sense before you choose a platform to make sure that it has the funds you want, but also that the fees aren't too high for the kind of funds that you want. Now it turns out that if you exclude emerging markets from your funds, it can actually reduce the fee. Now the justification for buying an emerging market stock is usually that growth is greater in emerging markets, and that means that potentially there's greater upside for the stocks which are listed in that country. Historically, that hasn't always panned out, of course, but still that's the theory behind ownership of EM stocks. Now it turns out that the stocks which are listed in emerging markets are less liquid. The difference between the buying and selling prices is larger, therefore, and that means that for the fund manager, it costs more to trade those stocks. And in some cases, they pass on that expense to you. So by excluding emerging markets from your fund and focusing just on developed market stocks, the overall management fee can be lower. So for example, I used to be on the Vanguard platform for my self-invested personal pension, and on that platform, I chose to use the fund VHVG. Now that's a developed market fund. It excludes emerging markets altogether. Now I didn't want to exclude emerging markets necessarily, it was just that the fee on Vanguard's platform was considerably lower for that fund than for their global VWRP fund. So the annual fee for VHVG was 0.12% per year, whereas for VWRP it was almost twice as much, 0.22% per year. But let me show you why that didn't bother me too much. If you actually look at a global index like MSCI All Country World Index, and we break it down by country and then by sector, this is what that fund looks like. Emerging markets make up a fairly small slice of that global index, around 10%. So in order for EM to generate outperformance for a global index fund, it would really have to shoot out the lights. That has happened in the past, but it hasn't happened recently. So that's why I wasn't too bothered on Vanguard about excluding emerging markets from my overall allocation. However, recently I moved my self-invested personal pension off Vanguard and onto InvestEngine. Now that's an ETF-only platform, so instead of being restricted to only Vanguard's funds, I'm now restricted to just exchange-traded funds, but that choice of exchange-traded funds is much wider than it was on Vanguard. And that also means that I can choose from a wider range of global equity funds, including this one from State Street, which is what I'm now using for my global index fund. And this one truly is global. Now, not so long ago, the fee for this fund was 3 times as high, but State Street very sensibly decided to slash the fee. Now it's just 0.12% per year. So that's the same as my developed market fund on Vanguard, VHVG, and I'm quite happy with this new global index fund. Notice that it does trade in multiple currencies, and that's often the case for an ETF. And if you look at the fact sheet for the ETF, usually it comes under a heading of listing and ticker information. Look for the version of the fund which trades on the London Stock Exchange in sterling. So in this case, the ticker of the LSE traded sterling denominated fund is ACWI. In other words, exactly the same as the acronym for the MSCI index. So very memorable. So I'm back onto a global index and I'm quite happy with that. And the fee isn't particularly high and I'm even happier about that. So we've been very careful with the fees, but another thing that's very important is something called withholding tax. So we saw that for a global index fund, 65% of it is going to be US stocks. Now, when you buy a US stock as a UK investor, not all of the dividends paid out by those stocks will be paid to you. US tax authorities will scoop off something called a withholding fee. Now, the amount of tax which they scoop off depends on various things. One of them is the domicile of the fund. So, for example, if you've got an exchange-traded fund which is domiciled in Luxembourg, the withholding tax is 30%, so you only get 70% of the dividend. If it's domiciled in Ireland, the ETF's withholding tax is only 15%. It turns out that you can actually get all of the dividend, i.e. pay no withholding tax at all, by going for a synthetic fund. So 30% of 1.3% is 0.39% per year. If you compound that over 30 years, that compounds to a whopping 12% of additional income. So domicile certainly matters for the exchange-traded fund that you choose. And if you do decide to go down the synthetic exchange-traded fund route, then you cannot pay any withholding taxes whatsoever. Now, there are pros and cons for synthetic exchange-traded funds. And to understand why there are some misgivings by some investors about having synthetic exposure, as it's called, you have to dig into how these things work. So you, the investor, hand over money to an asset manager. They then invest that money, and they can either buy the actual stocks in the index, that's called physical replication, or they can go down the synthetic route. And that means they enter into a derivative contract with one or more investment banks called a total return swap. This is just an agreement to say, I'll pay you the return as if you held the basket of stocks yourself. Why would they do that? Well, remember that the investment banks actually sit physically on the exchange in the US, for example. That means they're local investors. The shares are held on their balance sheet in the United States, after all. However, with the derivative contract, they agree to pay the returns of that basket of stocks to the asset manager. But crucially, that's paid without any withholding taxes. Now, what's the catch? There's always a catch. The catch in this case is that the asset manager has counterparty risk with those investment banks. If one or more of them were to fail, and that has happened, of course, in the past with Lehman, then they could potentially face a loss which would be passed on to you. So let's look at an example of one of these swap funds. You'll be able to tell it's got a swap inside it, and that's because the name of the fund often has the word swap in it. Alternatively, the fact sheet may use the word synthetic or synthetic replication. But from a user perspective, it feels just the same as a physically replicated fund. And you can see the fee for this MSCI World Tracker, which is a developed market fund, is 0.19% per year, so not very expensive. If you look at the web page describing that fund on the Xtracker's website, they have this section on swap counterparties. Why is that? Well, because investors presumably are worried about the counterparty risk. Is it a dodgy bank? So you can see here that they've split the risk between 3 different investment banks: JP Morgan, Morgan Stanley, and Goldman Sachs. So is it possible that one of these banks could fail? Yes, but is it likely that more than one would fail? I think that's very unlikely. Furthermore, the derivatives are marked to market regularly. That means that a big loss or profit can't build up, and that in turn means that the loss if one of these counterparties does fail is never very large. But the fund manager will tell you who the counterparties are, so you can judge for yourself whether you're happy with that counterparty risk. Another thing to watch out for is that sometimes the expense ratio is split so that the swap fee is separate from the expense ratio for the fund. You can see that for this S&P 500 tracker, which is a synthetic ETF from Invesco, where the total expense ratio is just 0.05%, but if you look at the swap fee, that adds an additional 0.07%. So just watch out for that in case the fee is split that way. So if you were listening to all of that and thinking, I've got no idea what you were just talking about, Ramin, well, don't buy it. It's really important not to buy a fund that you don't understand, and I think that's why some people aren't willing to buy synthetic funds, even though you get the return boost from keeping more of the dividend. Personally, I'm quite happy with that risk, but I appreciate it's not for everyone. Now, if you are one of our premium website members, we have this database of the cheapest funds which are available. Not all of our members are based in the UK, some of them are from the US, some from Europe, but let's focus on the UK for now, and we'll focus on global equity. So here are some of the cheapest global equity funds for the UK. Not all of them trade in sterling, which means that if you do have to convert your money to dollars on your platform, you can pay a currency conversion fee. So sticking to sterling to avoid that currency conversion fee can be a good idea. Notice also that some of these are income funds and some of them are accumulation funds. Income funds will pay you out a dividend in the form of cash, which you then have to reinvest. Usually I stick to accumulation funds because then I don't have to do that. But at the moment, the cheapest global fund is this exchange traded fund from Amundi, which has a fee of 0.07%. I don't use this one because it's an income fund. Instead, I've gone for this Spider MSCI All Country World Index tracker. I do pay a slightly higher fee of 0.12%, but I don't have to worry about reinvesting dividends. If we now focus on developed market equity, notice that the fees here are even lower. So for example, this Amundi Prime Global ETF, again an income ETF, has a fee of just 0.05%. Now not all of these are exchange traded funds. Notice that this Vanguard one is just a normal OEIC. It doesn't have the word ETF in the title. Similarly, the Fidelity Index World Fund is not an ETF. So depending on the platform you're on, there are benefits and drawbacks of ETFs versus OEICs. Notice also that the OEICs don't have a ticker. So in conclusion then, I don't think it is an obvious choice of which fund is best for you. It depends on the platform you're on. It depends on your tax treatment. Do you want to go down the synthetic route, or do you go for physical replication and pay some withholding tax? And of course, your choice of platform will affect whether you can buy funds in the first place, or you just have to stick to ETFs. And of course, another consideration is what the holding fee will be for that type of fund or ETF on your platform. On some platforms, if you have a very large holding, it can be considerably cheaper to stick to ETFs. But hopefully that's given you an idea of which funds might be suitable for you, and you can now do your own research with greater knowledge. Now you saw that database of the cheapest funds, which is available to our premium website members, but you get lots of other goodies as part of our membership. For example, you get a 40% discount on an unbelievably powerful cash flow planning app called My Finance Future. Plus you can ask a question whenever you like on our chat application. Plus we've got an extensive library of explainers, video explainers, which I've been building up over many years. Now, if you did want to find out more about our membership, just go to pensioncraft.com/membership. There's a link to that in the description below. And as always, thank you for listening.